I believe that the shocks that we'll face are severe but survivable, but I definitely believe that people who prepare won't just survive, they'll prosper.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for December 13th through December 20th, 2022, while supplies last. This week we feature two sovereign coins, the 2022 Silver Krugerrand and the 2023 Silver Britannia with Queen Elizabeth, both at $4.75 over spot, the lowest premium we've seen on sovereign coins in almost 2 months. Made by the Rand Refinery and the South African Mint, the Krugerrand is one of the most recognized coins today. These silver Krugerrands are 3/9 fine and feature a springbok antelope on one side and the portrait of Paul Kruger on the other. The 2023 Britannia from the Royal Mint in London still feature the portrait of Queen Elizabeth II, even though the Royal Mint has already started minting some coins with King Charles. This makes this first run of 2023 Britannia likely to be the last Queen Elizabeth Britannia issued. Both the Silver Krugerrand and the Silver Britannia come $25 to a tube and $500 to a box, and both are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this respected returning guest, Rick Rule, the former CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Thursday, December 15, 2022. Rick, thanks for coming back on Liberty and Finance.
Well, Dunnigan, best of the season to you and to your family, and of course to all your listeners and viewers. It's important, I think, to take time at circumstances like this to reflect on the year that's gone by and to look forward to the year ahead of us. And if I may say so, to make each other smile. So best of the season to you and yours.
Well, I don't think I've ever made it through one of our interviews together without cracking up myself, so I'll look forward to that again today with hope. And hope is a good thing for us to hold in our hearts, I think, at this time. We have so many strange things going on in our country and in our world that it's almost an incessant hand-wringing that it's easy to get into. And I think it's just as important to remember to hold out hope for promises ahead and brighter spots and to see good where, and to acknowledge good where it's found. One of the things we promised our viewers last time was we would get to viewers' questions, and we will in just a few minutes, because I think this may be unprecedented how soon after our last interview we're having you back on. It's only been a little over a week, but we wanted to get right back on your schedule because we had so many viewers' questions we didn't get a chance to address last week. But there's one thing that happened in the past week that we have to address first, and that is this debacle of FTX and Sam Bankman-Fried that's been going on. It's been surreal for many people seeing someone who evidently, perhaps by early reports, may be responsible for the fleecing of huge sums of money from large numbers of people, being treated still as a celebrity pretty much during these eras and going around giving speaking engagements, etc., and not seeming to be subject to the law that maybe the rest of us would be. And we wanted to take a moment with your help and to just look at that kind of objectively from a general investor philosophy standpoint and say, what are lessons to be learned from this unfolding disaster, and that we can generalize to other parts of our life, that, you know, rather than just clucking our tongue at, oh, those poor souls that got tangled up in this, where can we benefit from it individually and learning from it? 3
great lessons. The first of all, most people who invested with FTX, if that's the right phrase, or entrusted digital assets to them, did so without enough knowledge of the assets that they were trusting to FTX and with no knowledge whatsoever of the institution that they were trusting their money to. In other words, I hate to say it, but many people were the authors of their own demise by not having any earthly idea what type of assets they held or who they were entrusting it to. It is possible in conventional banking, as an example, to pay attention to the balance sheet and the income statement of your lender or the institution that's holding your funds. Do it. You are your own first line of defense. If you don't understand a financial instrument, don't buy it. If you don't have some sense of the institution, Be it a brokerage, be it an insurance company, be it a bank that you're doing business with, don't do business with them. You are your own first line of defense. Let's go deeper. FTX had investments from some of the largest institutional investors in the world. Sequoia, one of the best venture capitalists on the planet, could not have done the requisite due diligence that one would expect before placing $300 million with them, because there was nothing to do due diligence on. You couldn't examine the board of directors because there wasn't one. You couldn't examine the balance sheet or the income statement because it was in the drug-addled mind of the proprietor. Do not trust the due diligence of large, so-called reputable financial institutions because it isn't getting done. Don't trust the regulators either, because in many circumstances they aren't regulating. They're responding to political pressures or they're responding to complaints. FTX reminds me of nothing so much as Enron. Where were the regulators in a $100 billion fraud? The violations were actually in the annual report. Did the regulators bother to read the annual report? Even more egregiously and even more reminiscent of FTX was, of course, the Madoff scandal. Madoff was presiding over an entity, a broker-dealer, that was allegedly audited every 2 years for 16 years. He should have been subject to 8 audits. In an audit, you take the trade blotter. You pick some number of trades, say 40 at random. You call up the seller to verify the trade. You call up the bank to verify the transfer. In other words, you look at both sides, both entries, to a double entry bookkeeping system around an audit. The Madoff entity that collapsed didn't make any trades. How could they possibly have survived an audit that examines trades that didn't occur? And yet, this was a $30 billion failure. Do not trust the regulators to protect you. My friend Doug Casey refers to the SEC as being an acronym for the Swindlers Encouragement Committee. Do not trust that the biggest investment managers in the world do requisite due diligence, because FTX proves that they don't. Be very careful about investments that you don't yourself have a rudimentary understanding of. Oh, and one more thing, Dunnigan. It would seem at FTX that billions of dollars went to the institution because of influencers. Why on earth would an investor care what an actress or a basketball player has to say about a very complex financial topic, like a derivative on a crypto? What is it about a basketball player's background that would make you think that he or she has the financial sophistication to understand something that clearly Sequoia Capital didn't? How about an actress? Is there something in Kim Kardashian's background that makes you think that she's a reputable financial analyst? But yet, thousands of people, maybe millions of people around the world, take their advice on very complex financial topics from people who have no demonstrated expertise in finance. The lessons here are everywhere. Cause your understanding to increase. As you understand more, you can do more. Don't attempt to farm out responsibility for your financial future on institutions who have proven themselves to be incapable of providing it.
Point out that most ordinary people feel that there's a gulf that they can never swim across between where they are and being able to understand balance sheets and that sort of thing. So where does that leave an ordinary person? I mean, yourself, you've got an entire career of doing this under your belt. Most people don't. So if they can't trust that the biggest investment firms are doing proper due diligence and they feel that they personally don't have a prayer of doing so, where does that leave an ordinary person as far as options that are still open to them?
Your listeners should, at a minimum, do 2 things. The first is to buy a copy of a book called Economics in One Lesson, and then read it. Don't just buy it and pet it, read it. If you read economics in one lesson, you will understand the way the economy works, not the way that the big thinkers wish it worked. That's an important understanding. The second thing that you can do and should do is buy a book called The Intelligent Investor by Ben Graham. Relative to the effort required to read it, it's the best financial book of all times because the effort required to read it is low. If you read The Intelligent Investor and apply the lessons that you learned in The Intelligent Investor and don't make the mistakes outlined in The Intelligent Investor, you will be a successful investor. You might not make as much money as somebody who is more aggressive. You might not make it as quickly as someone who is more aggressive, but you will not run afoul of Bernie Madoff. You will not run afoul of Enron. You will not run afoul of FTX. In other words, while you might not get everything right, you won't get very much wrong either. Buy or borrow and read 2 books, Economics in One Lesson and The Intelligent Investor, and apply the lessons. Do not be a victim. Be proactive with regards to your own financial future. Not taking control, not taking responsibility for your financial future guarantees that you will not succeed.
We've got a whole boatload of viewers' questions we wanted a chance to take a crack at, so maybe we'll try the rapid fire method that we've tried sometimes in the past with your classic pithy answers to these. Chris H. asks, people are divided on whether or not the Fed has really started to pivot. What's your take, and do you think that the rise in silver price recently is a temporary overreaction to this?
The first part of the question, the Fed pivot, I see no evidence of a Fed pivot. 50 basis point rise is admirable courage on the part of the Fed. I would caution people that the effects of increased interest rates often lag, which is to say we may see the effect in durable goods orders or residential real estate pricing or new construction 6 months from now, as opposed to 6 hours from now. But thus far, I am really amazed at the durability of the U.S. economy, given the reliance that the economy has on leverage and the increase in the interest rate. With regards to the rise in silver, I suspect silver was merely underpriced. I think what you saw in the silver price was very much a dead cat bounce. I think, too, that the shortage that we have seen in retail silver products and the premium that retail investors pay to buy retail denominations began to find its way into the rest of the market. We were way, way, way undersupplied with 1 ounce product, 3 ounce product, and 10 ounce product. And the consequence of that is that much more kilo and 10 kilo product got melted down and turned into retail product, and we began to see a shortage of supply across all of the physical markets rather than just in the retail market, which would suggest, Dunnigan, much to everyone's surprise, that markets work. I don't think that the increase in the silver price has much to do with a Fed pivot or the prospect of a Fed pivot. I think it has to do with the fact that underlying demand at the retail level really surprised the distribution networks and really surprised the refiners. It surprised me, frankly, and that the increase in silver had to do, first of all, with the fact that it was underpriced, and second of all, the impact that you would suspect where demand exceeded supply.
Still on the same theme about silver's move, Rob McLean asks, silver seems to be starting to take off. What about mining stocks? Are they a good investment now, or should we stay in physical metal? I know that's very specific, but just if you could describe the trade-offs and the principles involved in people making that decision for themselves.
I think the trade-off has to do with how much risk somebody wants to take. I believe it's much, much, much more likely than not that the silver price increases. And an investor buys the asset class that he thinks will increase in price, which is to say the silver price itself. For people who are willing to do more work and to take more risk of single company failure, the silver stocks have traditionally provided much more upside leverage to silver than silver has itself. But the opportunity for mistakes, the opportunity for failure, and the penalty that one pays for volatility is much higher in the stocks. If you're not prepared to do the work, if you're not prepared to take the risk, buy the silver. If you are prepared to do the work, if you are prepared to take the risks, then by all means, come into the stocks. I have been in these markets for almost 50 years. I can't tell you why, but I can tell you that silver lags in the beginning of a precious metals bull market. The market is led by gold. But silver has more price volatility and a lower purchase point. So later in the market, it goes further and faster. And the most volatile of all asset classes are the silver stocks. The combined market capitalization, the silver stocks, is insufficient to hold the flow of funds that come into them when the generalist market participants are attracted to the silver narrative. I'm not saying that that's going to occur, or if it does, it's going to happen quickly. I will tell you that I've experienced it 3 times before in my career. And it's an awful lot of fun if you're in place before that boom occurs.
Yeah, it's a principle we've talked about, I guess, if we generalize to preparedness in general, our channel since 2013, talking about reluctant preppers and awareness and preparedness, it's a lot more possible to get yourself positioned in advance when it's not obvious to most people that that's necessary. And it's no fun at all to try to do it after the fact. It may not be even possible. Yep. There's a couple questions here continuing on the same theme. One says, what area, this is from Fantanaranya, what area of the precious metals complex do you see as the most undervalued right now?
I'm not sure that I can answer that question. That's an absolute question, and in many senses, valuations are relevant. I suspect that for the speculator who is willing to do the work, that the exploration sector is the cheapest. And when I say the exploration sector, remember that there are 1,500 companies worldwide at least engaging in exploration, and most of them are valueless. But within that subset, there are probably 150 companies that look like they are close to an economic discovery. And economic discoveries yield truly spectacular financial rewards. The exploration sector is as unloved as I have ever seen it in almost 50 years of participating in it. It is perpetually overvalued for those who don't do the work. But for those who are willing to do the work, it is really, truly, and thoroughly an unloved sector. I will share, however, that the gold producers, measured by the metric net present value, that is to say the net present value of future cash flows, discounted back at any reasonable interest rate, I use the U.S. 30-year Treasury rate, using current commodity prices or the forward strip, is cheaper relative to the enterprise value of the companies than it has ever been at any point in time in my career. I'm not saying that gold stocks are cheap. I'm saying that they are cheaper than they have ever been at any point in time in my career, which is not an unattractive entry point if you believe, as I do, that gold and silver prices, at least in nominal terms, in U.S. dollar terms, will go higher.
This is related, and you may have answered this enough, but see if there's anything you feel is missing here. Charles Lockey says, Rick, how do you value exploration mines with known deposits, which is to say positive drill results that quantify amounts and grade?
I begin to calculate in my own mind something that might resemble a preliminary economic assessment. I develop a target size, which is to say I try to look at how big the deposit might become, how big it's likely to become, and what my risks are associated with that. I do a very rough tonnage and grade calculation, which is to say tonnage times grade, to look at the in situ recoverable resource in place, and I estimate as best I can what the upfront capital costs might be to put it in production and what the operating costs might be. I use that number discounted back by the amount of time I think it might take to put the thing in production, and I look at the probability of the deposit being acquired, likely by a company which is already in production somewhere in that region. Note that I'm not trying to get this exactly right, because I never do. I'm trying to get it more right than my competitors. I'm trying to establish a range of values so that I can look at the upside in my speculation and the downside in my speculation. I also, too, try to examine the source of the information. There are some management teams who consistently underestimate or accurately estimate the results of their drilling. There are other serial underperformers who are wonderful promoters in the near term, but never seem to deliver value in the long term. So I assign qualitative marks for high quality, serially successful entrepreneurs in the sector.
We've got one more in this tack before we ask a different type of question. And that is about, you mentioned just a few moments ago about your confidence that we're still in the secular bull market phase, as you've seen in the past for gold and silver. There's a question here from 9999 who says, with a global recession almost certainly in the very near future, that's one assumption, what will happen to gold and silver prices? So if we take that in two parts, do you believe we are heading into a global recession or not? If so, why or why not? And then secondly, if so, how, or based on your expected direction of the economy globally, what do you think the outcome of that will be on gold and silver prices?
If I can assign myself a less constraining time estimate, which is to say in the next 1 to 5 years, I think a recession is probable, simply because we haven't had one for a very long time. And the almost necessary result of increased interest rates is a recession. So I think a recession is probable. I can't tell you when. If the recession is combined with a liquidity squeeze, which is to say, if the slowdown, if the recession causes a hiatus in the formation of credit and the investment in credit, if we suffer a liquidity squeeze, perhaps as dramatic as the one in 2008, in the very near term, gold and silver prices will fall because the price of everything falls. If the policy response to a recession and to a liquidity squeeze is similar to the ones that have accompanied every liquidity squeeze since the end of World War II, which is to say artificially low interest rates, quantitative easing, and the debasement of the medium of exchange, then one would expect to see gold and silver do very well. In the absence of a recession, because a recession isn't guaranteed, just because I think there will be one, as long as we have negative real interest rates, as long as the policymakers declare war on savers to the benefit of spenders, as long as we receive 4% interest on our U.S. 10-year Treasury in a currency that's debasing itself to the extent of 8% or 7% compounded, the gold price can be expected over time to do much better than the currency and much, much, much better than the long bond denominated in that currency. To the extent that inflation really falls, to the extent that the big thinkers allow a positive return on savings, to the extent that the interest rate rises, to the extent that the currency can do well for fundamental terms, by the way, all conditions that I do not think will be met, the gold price will do poorly, and the currency and savings instruments like long-term bonds will do well. I believe those circumstances to be illustrative, which is to say fictional. I don't think that they'll take place, but certainly they may.
One last question here from viewers before we wanted to follow up with a statement you made earlier about liquidity. Jack Mann says, with CBDCs, the government may try to destroy all the old debt, making the old currency worthless. Does Rick think, or what does Rick think will happen to gold and silver as they try? Will they survive, and will governments introduce a ban or a tax on metals? So these are theoreticals, but in an era of potential central bank digital currencies, what do you see of the future of physical precious metals held by ordinary investors?
I think that the probability of a universal central bank digital currency is low. I think they'd like to do it, but I think, among other things, 400 million handguns in private circulation mitigate against it. I can tell you that it's a chilling prospect. The idea that they could control all financial transactions and that they could merge the central bank digital currency technology with the social scoring technology in active use in China today is terrifying. They wouldn't have to fine you. They could simply cancel your currency. The consequence of that is that although I believe that the probability of a central bank digital currency is low, I've begun to do two things, which is to say I've begun to use much more cash in my own transactions simply to encourage merchants and other people to use cash. When I give a tip at a restaurant now, I tip in cash, not on my credit card. And I say to my server, this is not a tip within the meaning of the IRS codes. This is a gift. A tip is taxable. A gift is tax-free. Encouraging people to understand, first of all, the perniciousness of tax, and second of all, the utility of cash. The second thing that I've done is I've actually bought some junk silver. I think the probability that I will have to use small denomination precious metals as a medium of exchange is low. But the fact that I'm able to afford to buy junk silver, the fact that I think that silver will do well over time, and the fact that I regard my own purchase of junk silver as a potentially, how would you say, disrespectful act towards the promulgator of these fake currencies, I get some psychological utility around buying junk silver. In addition, I think it's a philosophical expression that's important, and I can afford it.
You just made me crack up, and I saw that one coming because I had a very impassioned call from a client who had purchased junk silver from me in this past week. And on the phone call, she said, I'm really concerned because I see what I was charged. I'm really thinking I was terribly overcharged for this. And I thought you guys were reputable. And she said, you charged me, over 22 times face value for this junk silver that you sold me. And so I had to kind of walk her through why she is absolutely right to be indignant, absolutely right to be inflamed about this, and that the target of her ire should be directed at those who are destroying the dollar. I said, the silver hasn't changed. Those same dimes and quarters that we held in our hands when we were kids have not changed. They are the same, and the silver is the same, and it's maintained its same purchasing power. It's the dollar that's gone down the drain. A buck ain't worth what it used to be, and that's evidence right in front of you. And I think it comes home to roost in people's minds more clearly with junk silver than with any other topic that I'm aware of in this entire, everything we've ever talked about, you and I, over all these years. When they're holding a 90% silver dime in their hand, and they remember holding one like that in their hand when they were a kid, and at that time, two of those could have bought a gallon of gas, and today, two of those could buy a gallon of gas, and they realize, wait a minute, something has changed, and it's not the silver. I don't know if you have any further things to say about that before we get into the question about liquidity and solvency.
I think that's a great point. When I was a young guy, a very young guy, like 6 or 7 years old, I used to like a brand of candy called a Butterfinger candy bar. And I remember that a dime could buy me 2 big Butterfingers, at least one more than I should have eaten. That same big Butterfinger candy bar I saw in the store the other day at $1.75 for one. So it's gone from a nickel to $1.75. And by the way, it isn't that they're using better chocolate or better peanut butter or better salt or that's in a better wrapper. The fact is that the medium of exchange is what has depreciated. A Butterfinger is just as good as it used to be, mercifully. It's just that it costs more than 25 times as much. I point out, too, on this show and others, that when I was somewhat older, let's say 21, 22, I used to have occasion to stay at a hostelry called Motel 6. It was called Motel 6 because a room there cost $6. The other day in northern Washington, I drove by a Motel 6, and the sign said, Motel 6, $119.95. Now, there's only 2 explanations. It could be that a room at Motel 6 now is 16 or 17 times as spacious. It could be that the interior furnishings and fixtures in a room at Motel 6 are 16 times as nice as they were when I was a young man. And I will admit I haven't had occasion to do due diligence on Motel 6 recently. But my suspicion is that the reason for the price increase has nothing to do with the relative spaciousness of the room or the finery of the furnishings and fixture. I think it has everything to do with the depreciation of the medium of exchange. The same phenomenon that you noted with regards to a bag of junk silver.
Now, one thing that you brought up in passing earlier on was about the difference between liquidity and solvency. I think that's something that is not necessarily appreciated by most people. It has to do with individual households. It has to do with nations. It has to do with companies. Can you talk to us about why that confusion needs to be dispelled, why it's important to understand the difference, and where the examples are you think that are the most important for people to realize?
Well, Donegan, first of all, thank you for addressing the question in that fashion, because many people think that all the sin in society is centered with government. It may be that the source of all sin is centered with government, but the question of liquidity versus solvency is one that must be addressed at the household level before you address it at any other level, because you control that. You don't control the government. On a personal level, the best illustration of the difference between solvency and liquidity is a family that has, let's say, a $500,000 mortgage on their house, but they've become unemployed. They have no means to service the mortgage. They have $10,000 in their jeans, which means they have liquidity. They can go out and buy a steak. They can go out and buy gasoline. But the truth is that their liabilities exceed their assets. They do not have the ability, without an adjustment of living standards, to maintain solvency, to in fact keep their house. If you look at that same phenomenon on a larger scale, in the U.S. at the federal level, we have $31 trillion in on-balance sheet liabilities. That's 31 with 12 more zeros to the left of the decimal point. More alarmingly, the off-balance sheet liabilities, Medicare, Medicaid, Social Security, exceed, by the government's estimates, not mine, by the government's estimates, $100 trillion, which is to say at the federal level, as a society, we owe well in excess of $130 trillion. That's the solvency issue. We're trying to pay off this obligation. We're trying to service the obligation with a federal budget that's in deficit $2 trillion a year. In other words, we're in this hole and we're digging it deeper. But we have lots of liquidity. Because of confidence in the system, we can, when we choose to, print money. And individuals within the system who don't understand that they're jointly and severally liable for this $130 trillion obligation, because they have cash in the bank, confuse liquidity, the fact that they have cash, with solvency. The fact that the government, the fact that the arbiter of how we live, the so-called provider of the goods and services and the pensions that we hope to enjoy, is broke. It's insolvent. That's the difference between liquidity and solvency. If you look at a corporate level, a company that has more debt than it can service, or that has development obligations, in the case of somebody building a mine, might be insolvent at the same time that they have $2 or $3 million in the treasury. They can pay their financial public relations bills. They can send out annual reports. They can pay their president. They can pay their CFO. The difference between liquidity and solvency is precisely what it says it is, but it's a pernicious trap. When equity investors look at momentum, when they look at a market that's being driven by liquidity, they pay less attention to value and less attention to solvency. Being lulled into a sense of security by liquidity often means being trapped and, dare I say, eviscerated when liquidity runs headlong into solvency and is insufficient.
And you've pointed out in the past, in fact, that not only is our nation gravely insolvent, but but also gravely out of balance in terms of cash flow. So you can't service. You have to keep this artificial pump of creating obscene amounts of currency of this artificial liquidity, because you're not only that far in the hole, but you're getting farther in the hole every period.
And let's make people sicker before we make them well. That's at the federal level. I didn't add back state and local debt and deficits. What you say is very true. The income statement, which is to say the excess of outgo over income, is troubling. But it's particularly troubling when you look at the size of the obligation. The other thing that I would encourage people to look at, since we're making them sick, and I hope we make them well later in the broadcast, is that many of the pension schemes, not just Social Security, that people are relying on to keep them healthy in their old age, are themselves grievously underfunded. Many of the pension and profit sharing plans have, as to the majority of their assets, financial assets, very long bonds. In an environment where the interest rate rises, the capitalized value of distributions falls. So when a 30-year treasury is priced to yield 2%, it's worth a little more than half as much as the same obligation is when it's priced to yield 4%. To the extent that big pension funds have large holdings of long-term bonds, the first thing that happens is that the capital value of those distributions happens. But the second thing is even more pernicious. To the extent that the pension plan is receiving, in today's terms, on the U.S. Treasury, 4%, and they're using it to afford purchasing power in a currency where the purchasing power is declining by 7%, what happens is that you're having a 300 basis point or 3% decline in the purchasing power of the revenue stream of the pension plan. If you take that 3% deficit and you compound it over 20 years, what you find out is that the pension plan will be able to provide the pensioner about half of the economic benefit by way of spending power that he or she thinks that they are due. The answer to this is that you control inflation. I'd love to see that happen, but I don't think it will. Or you increase contributions to the pension fund on a current basis to overcome the deficit, which I don't see most pension plans doing. Or you understand that 20 years from now, that your living standard will be about half of what you had otherwise expected it to be. And you take responsibility for your savings into your own hands. I would suggest respectfully that your listeners occupy door C, taking control of their financial future in their own hands.
I think this is gravely important to a vast majority of our subscribers. The demographics of our subscribers is heavily weighted towards late career stage and retirement age, and we keep hearing from individuals who say, my financial planner says I just stay with my annuity that's paying me a guaranteed 7% a year or guaranteed 5% a year, or my pension plan says they're guaranteed 5 to 7% a year, or one after another saying they've got some guaranteed benefit plan that it's been working for them for decades. Yeah, they've ridden out a few bumps along the way, but it just keeps on paying out. What do you foresee to be the fate of plans like that have perhaps for the past several decades been able to fulfill a commitment to pay out like 7% a year to those who have invested in them? Do you foresee that as realistic going forward?
Well, perhaps, but when you say guaranteed by who and guaranteed how? If the insurance company, which is offering up the annuity, goes broke, whose guarantee is it? Do you understand anything about the asset skew in the trust fund that's paying the annuity? Do you understand if they're solvent? Perhaps what happens is that the corpus of that annuity trust fund is in U.S. 30-year treasuries. Perhaps the pension plan is taking advantage of an odd accounting wrinkle, which says that they don't have to mark financial assets to market if they intend to hold them to maturity. Many pension plans can hold a bond with the intention of holding it to maturity and not reflect the fact that the bond, which was bought at 100, is now priced at 60. And when you look at the corpus of your pension plan, you look at a whole bunch of assets that, as a consequence of FASB, have not been marked to market, but are in fact worth substantially less than they're selling for. If that is the case, guaranteed by who? Believe me, your pension plan is not guaranteed by me. They may come for my assets to fund your pension plan, but they will find that I have done everything within my power to limit their access to my assets for someone else's benefit.
Well, I don't know how we're going to make people feel better here at the end, Rick.
That's easy.
Go ahead.
That's easy. We are, and have been for a long time, in an environment where people who pay attention to their financial future can continue to live in the most innovative, hardest working, transparent culture in the history of humankind. For everything that's wrong with the United States, I'm assuming most of your listeners are America, it's still the greatest social experiment that's ever taken place. It's still a culture, as I've said many times, where 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google, out pops Apple, out pops Facebook. Absolutely amazing. Dunnigan, for my whole life, going back to the Vietnam War, I've been concerned about the government's ability to wreck my life. Thus far, through my individual initiative and through my individual work, I have managed to prosper, despite their best efforts to wreck me. And the country has too. Our individual tenacity, our individual brilliance, our individual creativity is such that we have been able to afford our collective stupidity. And I think that we're going to be able to continue to do it. In fact, I think that prosperity around the world will continue to increase. I think that, and I don't want to sound woke, I think that because in the last 40 years, we've expanded the workforce. Women are now in the workforce. There are many people who believe from a sociological point of view that that's a bad thing. But expanding the participation of 50% of human IQ to wealth creation, I think is a good thing. In addition to that, with the distribution of technology and with communication, with 1,000 points of light like Dunnigan Kaiser, as opposed to, say, the New York Times, the ability to force misinformation down our throats is lower. And the ability, too, of young people around the world to enjoy the same benefits from education and technology that you and I have means that that garage that we talked about in Sunnyvale, California, may in the future be located in Lagos or Jakarta or Bishkek or La Paz. I think the future of humankind, to the extent that we rely on the goodwill of each other, to the extent that we are reliant for ourselves on other futures, on our future, and to the extent that we rely on getting ahead by providing goods and services to other people, we're going to do extraordinarily well. To the point where we rely on government, where we rely on coercion, we will do poorly. But I love the fact that alternative sources of information like your own are encouraging people to do the right thing for other people and do the right thing for themselves, rather than consign their financial future to the people who didn't see Enron, didn't see Madoff, didn't see and in fact benefited from FTX. So in that sense, I'm extremely bullish. I'm bullish about my future. You know, Dunnigan, I hate to belabor this topic, but when I talk to many of my former clients who are independent business people, they are uniquely and completely pessimistic about the direction of the country, and they are all optimistic about their own businesses and their own family. The fabric of society is all of these individual businesses, and these business owners are uniquely and ubiquitously optimistic about their future at the same time that they're pessimistic about the future of the country. I think they're wrong. I think that we have several reckonings to endure. I think that the future will be less benign than the past, but the past has been unbelievably rosy. I believe that the shocks that we'll face are severe but survivable, but I definitely believe that people who prepare won't just survive, they'll prosper.
You've often extended offers to help people get free information to make that more possible for them. Do you have those as well this time?
I absolutely do. I have a plethora of them. The first thing is that any of your listeners who care what I think about their natural resource portfolios are invited to find out for free with no obligation. Go to my website, Rural Investment Media. List your natural resource stocks. Please no crypto. Please no tech stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. In addition, if you're a speculator and an accredited speculator and you care what I'm doing in the private placement arena, I'll tell you for free. In the question and answer section at the Rural Investment Media rankings data site, simply say placements. And Dunnigan, as you know, I'm celebrating retirement by starting a bank. my seventh de novo bank of my career. If any of your listeners believe that they deserve better banking than they're enjoying from their incumbent bank, if they believe, as an example, that they ought to be paid interest on their checking accounts, if they believe that they ought to be able to borrow against good collateral like physical gold and silver, in the question and comment section at Rule Investment Media, write bank. And we will put you on the waiting list to become customers, either depositors or borrowers or shareholders, or all three of our new bank, Battle Bank. Battle Bank means that we battle for your business. We look forward to doing that if you give us the opportunity.
Well, Rick, our viewers often write me saying, tell us more about the bank or whatever. So that's how you find out. Go to Rule Investment Media, put in your name, your email address, and in the comments section, put bank. You'll get more information from Rick about that.
Or short circuit the whole thing and go to battlebank.com and click on the button that says tell me more.
Fair enough. We've been speaking with Rick Rule, CEO of Rule Investment Media. Rick, as always, on behalf of all of our viewers, thanks for this educational time spent together. We look forward to our next visit.
A pleasure, Donegan. And once again, best of the season to you, your family, and all of your listeners and readers.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Donegan, call 1-888-81-LIBERTY. That's 1-888-815-4237.